Good morning. Today is St. Patrick's Day. It is Thursday, March 17th. Thank you all for being here and joining us. We are getting initial jobless claims as we speak, and initial jobless claims coming in better than expected. Only 214,000 new jobless claims over the last week. That's down from 227,000 the previous week. Home starts also we're getting data on, and that is faster than expected. And we'll talk a little bit more about that as it relates to Lennar. But we're going to jump in really quickly, and I'm just going to throw it over to Tom here because it was the first rate hike yesterday since December 2018. It was the first time we've had liftoff from zero since December 2015. So it's been a long time coming, but it's certainly happened a lot quicker this cycle than it happened the previous cycle. Again, I mean, if you look back at the recession in 2008, it took 7 years to actually raise rates for the first time. This time it took two, less than that actually. So we're not making a decision on balance sheet runoff yet, but it will come at a coming meeting. And in the press conference, Jay Powell did suggest May for that decision. So Tom, talk us through what happened yesterday, and then we'll get back together and talk about the market reaction and what you expect going forward.
Yeah, well, it's funny because we've been talking about this now for 2 years, and the impending doom of raising interest rates has come and gone, and we're all still here. So I'm glad to see everybody on the call, despite the fact that the world ended functionally yesterday. If you asked anybody 6 months ago what would happen if the Fed raised interest rates. So yeah, the main takeaways is Jay Powell is taking it one meeting at a time. When asked if they were going to do any double hikes or if they're considering doing, multiple hikes or, potentially a triple hike, he basically said their expectation, according to the dot plot, which they published yesterday, is for 7 hikes, which was an increase from 3 from their previous dot plot. And there are 7 meetings left. And so basically he was saying at this rate, the idea is that we're going to raise once every meeting for the rest of the year for a grand total of 7 hikes. We'll see if we get there. Obviously, things change pretty rapidly in this decade. You could have a pandemic breakout or a war breakout with very little notice. But the big takeaway, I think, and I'd be interested to hear Ben's thoughts on this because we kind of talked about it a little bit yesterday afternoon, is that from Jay Powell's perspective, reining in inflation is the most important piece of the pie, because there's basically 3 pies here that the Fed deals with, which is inflation, the jobs market, and then growth of the economy. And so what Jay Powell basically came out yesterday and said, the most important piece is price stability, making sure that we can rein in inflation, because you can't have sustained growth and you can't have a sustained jobs market in a situation where you have price instability, which is, rampant inflation, things running out of control in terms of inflation makes it very difficult to understand where the economy is going to go. And so I think that's the big one. Is that basically, kind of in line with the ECB last week. They're saying we're going to sacrifice growth, we're going to sacrifice the jobs market in order to rein in inflation, because once we get inflation shored up, we can then be a little bit more stable on the other two, which are, basically keep us from spiraling out into complete financial crisis. Other notable takeaways, GDP number came down to 1.75%, which is the potential GDP. We saw the inflation number for the full year revised up to 4.1 from 2.7, which is still going to be pretty tough because they're anticipating that inflation will fall significantly towards the back half of the year, because we're 3 months in, we've already had 3 prints much higher than their expectation for the full year, which means that the average on the backside is going to have to be much lower. So I think that's an interesting takeaway, though. I'd also say 3 months ago, they thought it was going to be 2.7, which was pretty tone deaf, and the 3 rate hikes also very tone deaf. So I think we're having another situation where the market was saying one thing and the Fed was saying another, and the Fed basically had to come back to the table and say, hey, in the interest of credibility, we need to acknowledge that inflation is up, and then we need to raise rates, and we need to do it rather quickly. So those are the main takeaways. The third is that the Cisco-based WebEx that they had running the entire show crashed like 5 times during the press conference, and Jay Powell looked notably angry. People would get halfway into a question and then it would cut out, so he'd miss half the question and then have to stand there for a minute. So it was pretty awkward towards the middle. but they got it figured out towards the end. But you kept seeing the Cisco error box pop up, which was not a good look for Cisco.
Yeah, I agree with you, Tom. I think that those are the big takeaways. I think that it was interesting how Powell couched it, because he was asked directly that question almost. Are you prioritizing inflation, or are you prioritizing employment or growth? And he basically said, look, the employment market is really strong right now. And the only way we can sustain a strong employment is if we get inflation under control. So he basically said that, yeah, maybe we might sacrifice some near-term growth, but in the end, it's going to be a win-win if we can get inflation under control. So that's going to be our priority. Now, I don't know whether or not how much of this he can control. I do think right now the 4.1% call for the year is a little bit aggressive in terms of how quickly it's going to decline. I mean, I think if you look at shelter inflation, that's going to be stickier, and it's going to be stickier for some longer period of time. They're really banking on used car prices going back down, and they're starting to go back down, but they're going to have to really accelerate to the downside, which I'm not 100% confident of. I'm not even 51% confident of that. So I think it'll be interesting to see what happens with the Fed. They're very reactionary at this point in time, which you could argue is actually appropriate, because I think the past history has demonstrated that the Fed can't see the future. So why try to see the future? Just react to what you're seeing now, try to make the best policy decision based on the current data, and then move forward from there. Because as forecasters, they're notably bad. They actually had in their prepared materials a list of the error ranges and the confidence intervals for their annual growth targets and annual inflation targets. And they're off by 150 basis points on average, up or down, of their growth forecast for a given year. And that might not sound like a lot, but when you're talking about potential GDP growth of 1.75%, then the Fed is basically clueless as to what actually growth is going to be. So might as well just deal with what the economy is at the moment and then react from there. In terms of market reaction, the market actually went down a lot right when the announcement came out, because it was a more hawkish speech, and it was more hawkish press release than expected. He said that we're going to prioritize inflation over growth, essentially is what he said. But as he continued to talk, it seemed like the market became more and more convinced of his narrative that he was spinning, that the economy is very strong right now, and that ended up winning out. So basically, Powell operated as a soothsayer to the market, saying, don't worry, everything is great right now. The economy is in a very strong position, and market participants responded by buying stocks. And interestingly, the curve actually flattened. So Tom, you want to talk a little bit about the interest rates and the reaction to that and where you see them going from now?
Yeah, so similarly to the stock market, we saw a pretty big sell-off right after the comments that Jay Powell made. And then shortly thereafter, we saw a retracement, and bonds are actually up quite a bit this morning, but we have seen increased flattening on the yield curve, which is essentially, you're getting the same yield no matter where you are. And in fact, we're inverted at a number of weird spots on the curve right now. So right now you get paid more for a 7-year bond than you would get paid for a 10-year bond. 7 years yielding about 220, 10 years 216, and then also a 3.5-year bond is going to be yielding you more than a 7-year bond, because you're getting 216.5 on a 3.5-year bond. So things are very wonky right now. We're very, very flat on the yield curve. And there was an interesting interview with Jeffrey Gundlach yesterday, who's all-time weird character and runs the double line bond funds. He was saying that we're basically from a yield curve standpoint right in the middle of breaking one way or the other. Traditionally speaking, if the yield curve is flat and under 25 bips on the 210 spread, then we may be heading for a recession. But if it goes the other direction, then we're not, and we're basically flat right there in the middle. And the same with the 10s, 30s. He's basically saying everything is indicating that we can break one way or the other. Jay Powell seems very confident that we're not headed into recession. I would tend to agree with him that the economy is actually very strong. However, Jay Powell's also the guy who said that inflation was going to be transitory. So I would take that note as well. But I mean, the bond market's looking strong this morning. We're seeing a lot of retracement. It's not a big sell-off, but we're also not seeing, any break one way or the other in terms of one part of the curve getting a lot of demand. What we're seeing is basically all the way across, we're seeing equal demand for all bonds, regardless of duration, which is a very unusual place to be.
I think one of the narratives that supports what Powell was saying in terms of the economy being strong has been earnings, and especially as companies report at conferences, they're not walking it back from their full year guidance. And I think that's extremely significant right now. And to this morning, we have a bevy of companies coming out with earnings. We had Signet came out with earnings, they're up 8%. We have Williams-Sonoma, they're up 8%. And then over the past week, we've had UPS that came out and reiterated its full year guidance. You had American Express yesterday that not only reiterated their guidance, but also said that travel spending has actually rebounded as Omicron fears subsided. And also they especially noted that Russia and Ukraine situation is currently not impacting results for American Express. Dollar General issued their earnings release today. They also provided guidance for the next 12 months. And they said that they actually see fairly strong sales over the balance of the year, as well as especially strong margins. That really surprised markets to the upside. And then finally, Lennar, the home builder, reported outstanding results yesterday night, and especially as it resulted in average selling prices. Average selling prices are, up an incredible amount. You have a backlog that's up 24% in units, 24% in units, about 43% in value, because the average selling prices are up so much. Average selling prices up 18% overall, and that doesn't adjust for mix, because the West Coast is actually down 7%. Of course, prices are not going down in the West Coast. It's a mix shift there. But in the East, you got prices up 23%. In the central areas, you're up 12%. So average selling prices are going up. Gross margin is going up for the home builder, even in the face of higher interest rates, even in the face of higher wages, even in the face of higher lumber costs. They're able to generate some margin because demand is so strong. And I think that supports what Jay Powell was saying. And we're emerging from this vacuum of information from companies as these companies come back to conferences and as they get ready for the earnings season next month. I think that this narrative may hopefully continue, again, barring existential threats from Russia, Ukraine. But again, these companies are not seeing those threats manifest themselves in inferior results right now. So I think that's good news. Moving on to the Russia, Ukraine update. And Tom, I'll get your thoughts on this too, but just quickly with the news, the Ukraine resistance appears to be holding up well, especially in Kiev and kind of in the south as well, as Russia makes slower progress than they wanted. I think there are two things that we need to be thinking about when it comes to the Ukrainian resistance of Russia. Number one is the military resistance, and that kind of continues the way it's been going. But number two is the mentality, the philosophical resistance of the Ukrainian people. There was a big thinking from Russia that a lot of the Ukrainian people, especially in those southern cities, would end up kind of siding with Russia, but we're not seeing that. And I think that this is where Zelensky's brashness is paying off. The will of the people is not bending to the Russians. And I think that may be the big story, even more than the military resistance, and force Putin to the negotiating table, because the task of changing that mindset will be so difficult now that Zelensky's kind of entrenched the Ukrainian people into independence, which is good. The U.S. is sending 100 Switchblade drones. They're these 24-inch drones. They cost about $5,000 each. They weigh less than 6 pounds. They essentially attack by dive bombing their target. So these could be adequate defenses against tanks. So the U.S. is sending them 100 Switchblade drones. President Biden also called Vladimir Putin a war criminal yesterday in what the Kremlin says is an escalation. But then on the battlefield, Russia continues its merciless attacks. They bombed a theater in Mariupol in the south. Hundreds of civilians were gathered in the theater. There's a bunker underground, but people were also in the auditorium and on stage, just sheltering, and the Russians just bombed it. So it is brutal, but Ukrainian resistance holding up well. I think the market is taking that as a positive sign. But Tom, what are your thoughts on where we stand with Russia, and then maybe as it relates to markets?
I don't have a whole lot to add. I mean, I think it's impressive the level of resistance we've seen from Ukraine. I think that Russia's in it for the long haul now, and I think that they thought, hey, we could take these sanctions head on. We're going to go in there. We're going to take Russia. It's going to be, or we're going to take Ukraine. It's going to be fine, and then we'll be moving on once we take it. Sanctions will come off, and we'll be, right as rain. But that's definitely not happening that way. And I think the longer it goes on, the more difficult it becomes for Russia, just with the sanctions in place. I think that the average Russian is not going to be too happy about the state of affairs. I was reading some articles about there's a number of Russian people who are stranded, kind of all over the place. Either they've been on vacation or they've been out of the country, and now their bank accounts don't work and they're stranded. And when trying to get home, they're basically saying, hey, don't come home. It stinks here. Try and stay in Thailand or wherever you are for the foreseeable future, because living in Russia is an absolute horror show right now with the sanctions. So interesting stuff. I don't how much of that is true, how much of it isn't. It's sort of tough to say, but I think the sanctions are working. I think that Russia is between a rock and a hard place, and the longer this goes on, the tougher it's going to be for them.
Yep, I think this is good news for Ukraine and for the Western world in general. So we should be thankful for that. All right. Thank you for joining us. Happy St. Patrick's Day. Be safe. We do have an investment in Diageo. So if you want to buy some Guinness, go ahead and buy some Guinness and support the stock. But with that, we'll let you go, and we'll see you here bright and early tomorrow morning.